Consumers rely on credit cards to cover their spending on a variety of fronts, but they also know that there are fees associated with those cards. And for the most part, they are going to be fairly high. Still, many wonder why the rates we pay on credit cards are so high. To better understand that, you have to know the basics of so-called credit card banking. And that was the subject of a paper earlier this year led by our guest today, Itamar Drechsler, who is a professor of finance at the Wharton School and co-director of the Rodney L. White Center for Financial Research. Itamar, great to talk to you again. How are you, sir?
Good. Thank you very much for having me on.
Thank you. Obviously, this is a topic that a lot of people know about. It's in our daily lives. But what was it that drew you to want to look at why these fees are so high?
Actually, my co-authors, who are also my students, well, two of them are, and one of them is a former student, who's a professor at Columbia now. They came a couple years ago. They wanted to talk about fintech because everybody talks about fintech. And then as we were thinking about why fintech may or may not be able to succeed in the marketplace, the question was, what about the incumbents? And for a lot of these fintech kind of things, the incumbents, in terms of getting people to borrow or spend with some kind of payment or borrowing technology than the incumbent are credit cards. And we were like, okay, so what potential advantage or disadvantage do fintech have relative to the incumbents? And so we were trying to understand what's the economics of credit card banking. And one of the first things you see is just, okay, what kind of rates do credit cards charge? And they're extremely high. I don't borrow off my credit card, so I was less familiar with that. You look at them and they're just so much higher than any kind of return that banks make on any other kind of loan, or indeed any kind of other asset in the market. And so we're just interested in understanding, like, how do you get, there is competition among credit card companies. How do you get to this kind of rate?
Right. And there obviously are a variety of reasons for this, and you go through a lot of it in the paper, one of which is how these companies market themselves and those marketing costs, which have to be factored back into the overall fees that people pay.
Yeah, that's something people have been particularly interested about in the paper, I guess, because it's the thing that you don't expect or don't think of. I don't maybe people do expect it, but I didn't expect it. So when you think about it, the kind of more obvious things are that significant, not huge, but substantial defaults on credit cards, especially for lower credit scores. So you expect that, but that is nowhere near the rate that credit card companies charge. So the average credit card APRs right now is 23, 24%. 5%, let's say, is just the short-term interest rate that the Fed sets. About 6% is or 5% is kind of the average level of defaults. But that still leaves, if that adds up to, let's say, 10, 11%, that still leaves another 13% that is not explained by either of those kind of obvious things. And what we saw is that not the whole rest of it, but about a little under half, in a substantial amount, is explained by these guys' operating costs. Now, maybe I'm not very imaginative, but I never thought that credit card was particularly high operating cost kind of a business, but it turns out relative to all kinds of other banking, it is apparently extremely high. But one big piece of that is marketing. And it turns out that perhaps because a bunch of the credit card banks are not heavy on branches or physical locations or things like that, they spend a lot on customer acquisition costs as pure marketing. And I was surprised to see literally how much they spent. Operating costs are, about 5% of assets, meaning that for every dollar people borrow off a credit card, 5% of that, 5 cents of that, that they're paying in terms of their rate a year is just going to cover operating costs. And like I said, a big part of that is these customer acquisition costs. And it turns out that credit card banks are among the largest marketers that we see in the economy for consumers.
I also found it interesting, you note in the paper that the rewards programs that most of these credit card companies have, those are elements that are factored in as well.
Yeah, so the people are very into rewards. So rewards are very large. If you look at the amount of dollars that is paid out as rewards, it's really big. I mean, it's around depends how you judge, how you look at it exactly. But just the few largest credit card banks, which are the most, paid over $70 billion of credit card rewards. However, I should say, I think there's a misconception that this somehow explains the high rates on credit cards, and that's not true. The way that they pay that off is through the interchange. So that there's been some news reporting this week about a 20-year-old court case that was settled on this. So interchange is the fees that retailers pay whenever you swipe your credit card there. And maybe, I don't know how much people know about this, but they charge on average over 2% of what you're paying. They have to pay to the combination of the card network like Visa, and most of it goes to the issuing bank, and most
Right.
of that goes to people's rewards. So it's essentially a pass through. A lot of dollars that get charged as interchange. I think retailers, as this court case showed, really hate that, but they have not been able to get around it.
You mentioned as well, just the kind of the market power that these firms have as well.
Yeah, so I think a lot of this market, by market power, to be technical about it, mean their ability to charge a rate that is higher than sort of the marginal cost of providing the dollar of loans. So
Right.
it's not just the average defaults, the interest rate. It is above that. There is a markup above the cost of providing a dollar, but that markup in large part goes to paying things like the customer acquisition cost. So it's still the case that it's a markup. It's still the case that if they did not spend so much on customer acquisition marketing, credit card rates would be several percentage points, maybe more than several lower.
Mhm.
But the reason that that happens is because people respond to marketing. It works. So, I've talked to people about this. I think the best way to explain it is there could be an alternative credit card bank that would say, we're not going to do any of this marketing. We're going to save the money. We're going to charge people, let's say 3-4% less on their credit card a year. And people are going to like that. They care about lower rates, and they're going to come and they're going to take this credit card. That doesn't really work. People would not know about it and they would not respond to it. So such cards exist. If you really want to, you can go to credit unions that have much lower rates. But we can see their market share is minuscule.
Yeah. So, what is then kind of the best future outcome for the consumer in still being able to have the ability to use credit to their advantage when they need to, but maybe a path where you're not paying the higher rates, as we look down the road? Is fintech going to be something that is going to really delve into this in the years ahead?
So I think for people right now, they're the better options, if they care about this kind of thing, they're willing to go to the not big trouble, but small trouble of doing that, is to actually search. And so, for example, go to one of the credit unions that have this lower rate. There are also some banks. And another thing, which I actually really don't understand it completely, but I think it has to do with the fact that they spend way less marketing dollars on it, is that the same banks offer personal loans that are bigger than the amount of credit you could get off a credit card and have a lower rate. So, and actually, the people who use that, so that's not like nobody uses that, often use it to pay off their credit card debt. As far as I can tell, I mean, I don't want to be seen as giving financial advice to people, but that is a superior, exchange. You can get a bigger loan. You just have to control yourself from spending it, pay off all your credit card debt, and replace it. It's, credit card consolidation, as they call it, and pay what is often a substantially lower rate. And this is available from, Amex, Discover, Chase. They have that. It's strange, but it's true. And it's part of it is they don't market it, so they're not trying to pay, to get back the marketing dollars from the higher rate there. So I think that's clearly a superior trade for people, as far as I could tell.
Itamar, great to talk to you today. Thanks very much for your
Okay.
time.
Thank you very much.
Thank you. Itamar Drechsler, who is a professor of finance here at the Wharton School.